Let me just open with a note of gratitude. Everybody on this call is a partner in the exercise of philanthropy in some way through the Vermont Community Foundation. We're excited for the call today. Excited to hear from Mike Miller on our broader investment portfolio, and we've got a great update from Lawrence Miller, who serves as senior advisor for Vermont Mission Investing at the Vermont Community Foundation. And just, as a point of reference, one of the really important ways in which Community Foundation serves donors and fund holders and communities across the state is a 5% asset allocation to place-based mission investments. So it's doing everything from downtown revitalization to affordable housing to fostering entrepreneurship and innovation to supporting food and farm activities and farmland succession. And in every corner of the state, there are enterprises that are supporting people coming back into the workforce who are coming out of incarceration or coming out of treatment for substance use disorder. In this portfolio, we just returned from the Mission Investors Exchange, which is a big conference of foundations and asset managers. A few of us were out there, and it was really interesting to see the multitude of ways in which foundations are approaching this work, but really to recognize that the 20-year legacy of this foundation in place-based mission investments and really using philanthropic dollars to get upstream of the economic conditions that so much traditional philanthropy is asked to solve for is really remarkable. And that is only possible because of partners on the call who see the value of the community of philanthropy in Vermont and are willing to work with us and partner with us to do it. So I'll turn it over to Mike Miller. And Mike Miller and Lawrence Miller, no relation, just to be really clear. It just happens to be that most of our advisors are named Miller. Mike, why don't you run us through the Q1, the performance of the Q1 performance of the portfolios in Q1.
Happy to. Thanks, Dan. And Miller is one of those common names, so it's not a surprise you might have two of us with the same name. So good morning, all. It's really, really nice to be here with you today. And I'm going to move relatively rapidly through this. I'll try not to speak too rapidly because I want to make sure to leave plenty of time for Lawrence and for your questions. So what we've done here is some of these are slides you've seen before, and I'm just going to kind of walk through them with you. Again, please stop me if questions are at the end. There's plenty of time allocated for questions. So what you can see here are the returns for the long-term pool compared to the benchmark. One of the things we've been talking about for some time is the fact that the pool has not kept up with its benchmarks all the way out to 10 years. A lot of that has occurred in the last 3 years. And our problem has been that we have not been on the Magnificent Seven train to the extent that we probably should have. But we're going to talk a little bit about that today and what the future looks like and why we haven't been on that train and why we're not going on that train, just to be clear with the portfolio. The SR pool, which is a little more passively managed, which has clearly been a much bigger beneficiary of that trend, has actually kept up with its benchmarks, even exceeded them recently. Again, it has had significant premiums to the long-term pool, which is in part a proof statement about something that Dan alluded to, which is just the way that impact and the way that portfolios can be put together with multiple objectives without compromising on any of them, basically. So socially responsible pool, there used to be a debate, there's still a debate actually, about whether socially responsible portfolios can do as well as non-socially responsible portfolios. And I think the answer to the question, there is no answer to that question. A very well-designed socially responsible portfolio can clearly keep up with particularly with a non-well-designed portfolio. We have two well-designed portfolios here, as you can see, especially if you look at the longer-term returns to the long-term pool. In a minute, I'm going to show you how we think about this more recent spout of underperformance in the long-term pool and try to put it in some perspective for you. But before we do that, the midterm pool, which is a fully passive portfolio, by the way, with a few little tweaks, is for shorter philanthropic time horizons. So this is the kind of pool that looks really good, feels really good when you're in a period of difficult markets because it's got a lot more bonds in it than the other two pools do. And it's not oriented towards long-term preservation of purchasing power like the first two pools are. So if we jump ahead, so one of the things that I know we think about it crucial a lot, and the Community Foundation absolutely does too, which is the idea of consistency versus long-term outcomes. And what we're thinking about specifically is that at times, within reason, we're willing to make trade-offs, i.e. if we have to be a little bit disappointed with short-term results, as long as they're positive, over periods of time in exchange for higher long-term results, we'll do that. So if you go back for a second, So you'll see here, for example, the 6-1 versus the 6-5 for the long-term pool, then for 15 years. And since we started with the foundation 22 years ago, what the returns have been. And if you look at it this way, it's interesting because it takes those 15-year periods and the since 2002 period and really shows you what the impact was of having significant outperformance over those periods of time. Now, over the 10 years, though, we're still short. And so that's clearly something that we're not happy about. And the committee is working to address it, as are we, because we think the portfolio can always be better. So I hear a lot of typing in the back. I'm not sure who that is, but the portfolio can always be better. And what we're looking at is essentially a pretty decent trade-off. But I think more compelling than that is this. So one of the challenges, if you're looking at performance, is that we all have a tendency to look at the moment we're looking at, i.e. the chart I showed you earlier, and say, well, was it above or was it below? And if it was above, it's good. If it was below, it wasn't good. And the fact is that that's interesting because it changes over time. And so what if March of 2024 is a perfect predictor of the future, i.e. the long-term pool will not recover, it'll continue to underperform? Or what if it's not a perfect predictor of the future? What if it's an inverse predictor of the future, i.e. it's cyclical, and the long-term pool will come back and the socially responsible pool will continue to generate strong returns? So the way we address that question, and first of all, you can't answer that question, just to be clear, you can't be for sure. But what you can do is say, well, let's not focus on just this one time horizon. Let's instead focus on every time frame that we could possibly look at. So the socially responsible pool started in the modern era in June of 2010. And so what we've done here is we looked at every single 3, 5, 7, and 10-year period from that point to March of 2024. We're not ignoring March of 2024, and said, what percentage of the time did the socially responsible pool outperform its benchmark? And you can see that 69% of the time for 3 years out to 91% for 10 years. So we're actually pretty pleased with that. And this is interesting because it tells you one thing, very important thing, which is that because we're such long-term patient investors, you would expect to see what you see here, which is the rate, basically the hit rate of success is higher when you look at longer periods of time, because short-term has a lot of randomness and noise in the numbers. And so we're not really focused on that, but we are focused on that very high batting average. The median outcome underneath is meant to answer a second question, which is the is it worth it question. Because at one point, passive management, which I'm going to go on a little bit of a tirade about later, very quick one, I promise, has become very popular today. And it's very popular for good reason, but it's also very skewed and distorted today if you do it the wrong way. And what's interesting is when you're going to use active management, you do have to ask yourself the question, which is, am I actually getting a premium that's worth having? And you can see here, these are not per year, this is cumulative. But over the last 10 years, so the socially responsible pool has outperformed its benchmark 91% of the time. And it's also the median, i.e. the middle of the distribution, was a 6.4% return advantage, which is a pretty substantial return advantage. And then more important than that, maybe, or even as important, is the skew. So the best scenario was almost a 10% return premium, and the worst case was 4.8. And we see that the 3 years is the inconsistent one, but we think the 7 and 10 year, that skew where the good days are so much better than the bad days, is really important. So to me and us, this is a proof statement that the odds of success for this portfolio are very, very high over time. And I think that's a very important point. And I would also add the socially responsible pool does not use a socially responsible benchmark, i.e. it's not a screened benchmark, it's just a standard market benchmark. So this is also more back to the point about impact and values alignment and returns, not all being, not being at all at odds with each other. So now the long-term pool is a little more controversial because it hasn't been so great lately. And here you can see now our record goes back further because this pool has existed since we started back in 2002. And what you can see here, though, is a very similar picture, i.e. a 96% success rate. So that 10-year number I showed you earlier where the portfolio is behind is essentially a 1 in 20 occurrence. Now, unfortunately for me, that 1 in 20 is right now. And that's frustrating, of course, as you know, so we're not too thrilled about it. But we also understand that 100%, while a lovely idea, is a hard one to get to ultimately. So we don't really think that's the answer. We like 96. We wish the 4 just wasn't happening right now. The other thing is this portfolio is more actively managed. So these median outcomes are much higher. And now you get into some serious outperformance. 30 percentage points is the median output. Again, that's not per year. So think about it as about 3% per year outperformance is the median outcome. And then look at the best and worst case scenarios, the same story, a tremendous difference. 39% was the best case scenario. And the worst case, which is happening right now, by the way, is -2. So -2 is about 0.2, 0.3% per year. So that skew is hopefully a sign of that the fact that this portfolio has a lot of things going for it. Now, the last thing I'll say, and I didn't mention it earlier, markets do move quickly, they change quickly, and these results change. So we're running a very active portfolio. This is not an index hugging portfolio, as you can tell. And what's interesting about it is actually since March 31st, those numbers I showed you, the portfolio has already recovered half of its underperformance. So it's quickly catching up, and that's the momentum is actually quite good there. And that's through last night, just to be clear. So we're really very optimistic. And I think the bigger point is that not only are we optimistic, we have a reason to be optimistic because normally these things come around for us, and we've had other periods of underperformance before. So let me take you through the strategy quickly. The first is that we think long-term. That's why we say here 20-year periods. An impact in Vermont is a long-term proposition and a short-term proposition. The second thing is, as you've been on these calls with me before, we don't have a forecast for interest rates. We were not surprised that the US didn't go into a recession, not because we knew anything about those things, but because we knew we didn't know. And we know nobody knows. And so that's the problem. That's the issue for us, is that a lot of investing gets done based on false premises, which is that there are things about the future which we actually just don't know. And we don't like spending time or energy or taking risk with the foundations in your capital based on stuff where we have no edge. We have a huge edge when it comes to things we do well, but the things that we don't know about, we avoid. And then last but not least, and this is, by the way, I would tell you, and it's funny for me to think about this way because I've been around a while, too, a big student of the history of markets and what drives markets, ultimately what drives investment outcomes. And for most people, you hear the word diversification, it doesn't have a negative connotation for most of us. It's, for me, in fact, it's still been described in investing as the only free lunch out there. And that's actually absolutely still true. However, it's been the most unbelievable curse. And the thing that's hurt the long-term pool the most is it's actually diversified. It owns stocks around the world. It owns small cap stocks. It owns all kinds of different stocks. And so you just really want to own the Magnificent Seven. The SR pool has fared better, as I mentioned earlier, not because it's not diversified, it's very diversified, but it's also just got more passive exposure, which has kind of bailed us out of the diversification problem. I'm going to show you why we're so concerned about diversification today in a minute, but I'm going to move ahead. These are the strategic mixes of the three pools we mentioned earlier. So you can see the long-term and the socially responsible are pretty close in terms of their equity exposure. Long-term pool still has some hedge funds. Those will be eventually leaving the portfolio, to be clear. But what you can see here is the pools are quite similar, and they're both very oriented to long-term outcomes, which you can see from the lower fixed income exposures on the portfolio's pool. The midterm pool is more balanced, and this 47.5 is very much designed around the idea that the portfolio should be shorter term, it should be less exposed to volatility, and that's why we call it a midterm pool. And I mentioned earlier what that's appropriate for. So I'm going to be very quick here. Crucial spends a lot of time looking at active managers, trying to find active managers. There are 4 basic rules we follow. Returns are always accompanied by risk. We must understand the strategy, know the key people, and we don't like complexity, to be clear. Operational issues are a place where there's no risk taken. And the fourth point, this is the big challenge of 2024 right now, and the investment committee has been absolutely fantastic, no surprise there, as is Dan and team, which is that if you're going to have a forward-looking process, that means you need to be very vigilant and rigorous about how you assess past performance, but you also can't assume that it's going to be repeated exactly the same way. So some of the patience that has been asked for and so far accepted with the long-term pool's structure is very much built on the idea of what's going to happen next, not what happened last. And so it's a very important part of the process. I'm going to jump ahead and go to this, which is the world we live in is changing. We frankly, let's be clear here. The world itself, we're not so happy about. I'm sure most of us agree it's a very, very difficult, complicated world today we live in. From an investment perspective, this is one of the greatest climates and setups we've ever seen. Before the call, someone asked me if I was going to be retired anytime soon. And my answer was no, when I'm 58, so I don't need to retire yet. Hope. The second reason is that this is the best investment opportunity set I've ever seen in my career, full stop. I want to see how we can get our clients to really capitalize on it, particularly when there's going to be a massive gap between those who do it right and those who do it wrong. So the first thing, we have higher inflation today. And higher inflation has thankfully interrupted the Federal Reserve's ridiculous strategy of buying bonds and throwing trillions of dollars at the economy, which created all of the distortions we see, whether it was the ARK funds or all these other things that are just insanity, basically. And we're seeing it again. Of course, we're seeing the meme stock start to come back again, even without the Federal Reserve's help right now. But the point is that when you have higher inflation, it changes the way capital is priced. It changes interest rates, as you all know, and that's really good. And the second point, capital scarcity. In a world where there's money for everybody, then basically even garbage businesses can probably survive for a long period of time. in a world where there's not money for everybody, which is the world we're very much in now and are going to stay in, by the way, then even good businesses can be starved for capital sometimes, but bad businesses hopefully will definitely be starved for capital and be thrown out of the door. And while all this is happening, if you think about this, is a massive sea change from 2008, 2009, all the way to 2021. People are basically ignoring it for the most part of them. They like the higher interest rates they're getting. And that's why we see things like the S&P 500 getting more and more concentrated. And here's the challenge. When you talk about concentration, it's got a synonym in the investment world, which is risk. Concentration and risk are absolute synonyms. No excuse. That's never not true. I'm going to jump ahead for a second here. So this is one of the inconvenient truths for people who just want to own US large cap stocks, which is that you really do have to think about what you pay for an asset. If you pay too much for something, bad things happen to you. If you pay too little for something, good things happen to you. So let me just step back for a second and say something important. There are three ways in my career that I've seen people mess up long-term returns. The first thing they do is they buy bankrupt, crappy businesses, and they pay too much for them too, and they don't get back their money ever. And you can be as long as time horizon as you want, but if you buy something that's worthless, then time is not your friend. Second thing they do is they pay too much for things, like way too much for things. And in that scenario, it's the same basic outcome. You lose a fortune. And you really have a huge problem on your hands when that happens to you. The third thing people do is what we're doing right now, which is you underperform. And the good thing is underperformance, if you don't get, basically put off by it, if you don't get put into a place where you start acting irrationally because of it, underperformance is temporary, which is those 90% success rates I showed you earlier. So the point that I want to leave you all with today is when you look at these US large cap indices that have done so well, I mean, they're incredible how well they've done the last 10 years. When you look at this though, and you try to think about what the future looks like, there's actually some very, very clear guidance of what the future looks like. And this is in the form of what we call the Shiller ratio. So Bob Shiller is a professor at Yale, and he came up with this idea, which is a really simple one, which is why it's brilliant, which is let's think about how to value stocks based on 10-year inflation-adjusted earnings. And the reason you use 10-year inflation-adjusted earnings is 10 years, obviously a little bit, it's kind of random, but it's just a long period of time. But the reason you use that is it gets away from the cyclicality of earnings, i.e. earnings go up in a booming market, in a booming economy, they go down in a recession, and you don't really want to let that skew the measurements. And so this addresses that issue. So Bob very kindly on his website, or Yale's website somewhere, I guess it was, published every single Shiller ratio back to the 1880s, I believe it is. And what we did at Crucial, being the people we are, is we said, well, that's interesting. Let's just basically take all those Shiller ratios from 1880 for the S&P and put them in a model and take a look at what happened. So if you look at the different ranges there, what you see is that it runs from 4.8 to 10 at the bottom, all the way to 40.1 to 45. And you can see the number of times the Shiller ratio has been in each of those ranges. So the beige shaded area is sort of where we're at today. You can see the current CAPE is the Shiller ratio, by the way, is 34. So we can say it's kind of really near the top of one part of the range and near the bottom of the other part of the range. So we'll just highlight them both. So the first thing that should trouble you about this graph, this chart, is look how infrequently the Shiller ratio is this high. That's bad, really bad, because that is saying, wow, people are paying a lot for these companies today. That's really, really interesting. The more disappointing or troubling part of this is look at the far right. And before we get to those numbers on that median, so what we did is, just to explain what this is, we said, okay, we have all these Shiller ratios. Let's just look at what happened next. What was the next 10-year return from 1880 to 1890 and all the way up to 2024? And what happened next is the key point. And here's the thing. Think about in your lives, is there any place other than maybe the stock market where you like to pay more for something? Most people understand you go to the supermarket, you book a flight, whatever you're doing, less is more. You get more for your money, you're happier. In the stock market, that's not how it works. And because the reason it doesn't work that way is that what happens is when stock prices are high and stocks are popular, people feel good. And when you feel good, you kind of, especially if you don't have a valuation discipline, you're just happy. When stock prices are in these bottom Shiller ratio areas, terrible things are happening. The markets are in a very bad state when that happens. And so people don't feel good because they look at their losses and they say, oh my God, this is terrible. But if you look at that far right-hand column, the opposite should be true. Actually, the way you buy bread and eggs in the supermarket is actually the way you should think about buying stocks, which is pay less. And so you can see that if you're in this very low Shiller ratio, the forward annual return from that point was 15.1% per year. And it's almost a perfect correlation, i.e. the higher the Shiller ratio, the lower the forward return. And here's the thing that I will tell you terrifies me, which is that I think a lot of people who are invested in the index today very heavily probably are not expecting to earn 3% per year for the next decade. That's with dividends, by the way. They're expecting to earn 8, 9, 10, 11, 12. And again, this time could be different. Yes, that's always possible. But we look at 140 years, 140 years of history was, well, I don't think it's appropriate to bet the foundation's assets or yours on this being the one time in history. It's different. And even if you want to be an optimist, look at the 4.7 and the 7.1, which is the best outcome, the very best 10-year outcomes we ever saw in all these periods of time. We put those two together, you get about 5 or 6%. And so the only point we're making here is that this is a really, really significant issue for this day. And here's why the Shiller ratio is so expensive and why we're actually not, I said something weird before, which is the best opportunity set we've ever seen. And how can that be? And not because we're going to short the S&P 500, to be clear. The reason is partially because of this. So the top 10 names, so the way indexes work, each company is weighted by the size of the company. So right now, Microsoft is the most valuable company in the world. I think Apple might be second. And so as they get bigger and bigger and bigger, and they outperform everything else, they become a bigger and bigger part of the index. And so all this is meant to show you is that the top 10 names in the S&P are now a third of the index and seemingly rising forever. We'll see. But this chart should show you how unusual that is, how high that is. And again, concentration and risk are bedfellows. I'm not going to spend too much time on this, but just to point out, these are the Magnificent Seven. And here you can see Microsoft at 23%, biggest company, Apple is second. You can see that they're trading at 43 times trailing earnings and that the market expects them to grow at 37% per year, which is mostly because of NVIDIA, to be fair to this number. So if you take NVIDIA out, the market's expecting these names to grow at basically 18% per year, which then gets to an interesting question. So the remarkable historic growth, the 18% you see on this 5-year column, that's pretty cool. I mean, I got to tell you, nobody, including us, expected to see them grow that fast at this scale. And that's the argument for them, by the way, right there. The challenge, though, is that there's still an upper limit somewhere. I mean, I don't know about any of you. I'm not a huge fan of Amazon, but let's say you were a huge fan of Amazon. Are you going to be able to spend double what you already spend on Amazon right now? How is Amazon going to grow at 18% per year from this size? They can't actually consume the entire world's economy, I don't think. So there's an upper limit somewhere, which is really, really important. And here's the last point on this, which is that the reason people have been willing to pay this much for these stocks, these Mag 7 stocks, is because if you look at their earnings growth, and that's the red bars here in the middle, if you look at their earnings growth, that's the red bars are just the Magnificent Seven. The blue bars are the S&P excluding the Magnificent Seven. And if you look at all those numbers, you can see that they have trounced on the short-term basis, the excluding Magnificent Seven. And that's totally the reason that people are excited about them. People are not thinking about the valuation risks they're taking and the concentration risks they're taking. But now look at the columns to the right. We're about to enter an era, according to Wall Street forecasts at least, where the Magnificent Seven are going to grow at about the same rate as everything else. And if that happens, watch out. Because why would you pay double or triple the valuation of a company and get the same growth rate? Most people won't, and markets will shift when that happens because markets haven't completely lost their minds. So it's really interesting to think about that. And the point I left out earlier, which I want to emphasize right now, is that in this world of 43 times earnings and all these other things, we have a Vermont Community Foundation, both the SR pool and the long-term pool have tons of exposure to companies trading at 10, 12, 15 times earnings with actually really good growth, really good dividend yields, better than the Magnificent Seven. And so we're diversified. And that diversification has never been more interesting from our perspective when we think about the things that drive forward returns. So that leads us to the last slide. Almost right on time. Thank Lawrence. I'll give it to my brother Lawrence in a second. But my point is 3 things. First thing, we stick to things with a high probability of long-term success. So that's why you don't hear me talking about whether there would be a recession this year or not, because we just don't think we know anything, as I mentioned earlier. The foundation has hundreds of millions of dollars, which gives it scale and stability. And basically, despite my little comments before about the index and the concerns we have, the index still is a very good choice. It's just a less interesting choice today than it's been in quite some time. And so we're lucky in that we have options outside of the index. We can use both, essentially, which we'll continue to do because we do think fees matter quite a bit and indexes are cheap, which is great. And last but not least, you do have to accept investing is about uncertainty and volatility. And the best outcomes people get are when they understand those things, They take them on because they think they know, and I think we know, we think our managers here know that we understand the risks and we expect to get paid for them. And I think those are big, big factors that keep you, frankly, focused on the long term. The challenge a lot of people have is they want to be comfortable. That's how Apple gets to the valuation it gets to. It's a very big, safe business, and people want to be comfortable. That's why they pay so much for it. But the fact is that that comfort comes at a price. And comfortable, you shouldn't really be an equity investor if you want to be comfortable. Frankly, to be really frank about it, you should basically own less equities if you want to be comfortable. So let me stop there and pass it off to Lawrence. I'll stop sharing, Lawrence, so you can take over.
Thank you, Mike. And what you will notice right off the bat is that I have borrowed slides from some of my colleagues. When you see an attractive slide that is well formatted and clear, that is somebody else's work. And when you see one that's a little abrupt, that's mine. So what we want to do is go through an overview of the Vermont portfolio and talk a little bit about some of our investments. And then I'm going to talk about an investment that we didn't make and give you an example of the work that we do as a team and how having this activity at the foundation generates an impact that is sometimes not quantifiable. As a refresher, the way we look at this is that we do grant making and investing for community impact. So while Mike spends his days worrying about risk-adjusted returns at an appropriate market rate, we look at returns adjusted both for risk and for social impact. So we'll start with an idea of what an appropriate return is. That might go up with more risk, and it goes down with increased impact. And we deploy across a number of areas in Vermont, and we try to do that consistent with the impact areas that drive our grant making. You can find this on the website, and this will be out as well. So I come back to referencing this area. We have education and training, climate and the environment, democracy, trust and community leadership, health and well-being, and economic equity. We spend a lot of time in mission investing at VCF, focusing on the economic equity portion, putting capital to work in small businesses through intermediaries and through direct. And what we do when we look at this at a given investment from the perspective of the Vermont Portfolio Committee is we're really looking at what's the level of impact consistent with our mission. That's the first screen. Do we have a good reason to consider this particular investment? And then the second screen is, given the level of impact we expect to have, what are we willing to do for a rate of return that's acceptable in that context? And so if we're having a significant impact and we're filling our role in a way that nobody else could or would, then we feel like we are doing something that's exactly right. We'll work through a few examples, but we aren't just doing what a community bank could do or what one of the other members of the capital continuum in Vermont would do. We really look for what's VCF's unique role. Over time, this started in 2001, and by the way, you'll see that some of the categorizations we use are different in different areas. The opportunity gap language is new as of a few years ago, and some of our legacy documentation still uses different terms. They largely mean similar things, if not the same thing. So going back to 2001, 5% was set aside to do this work. And over time, it's grown quite significantly to being a fairly meaningful participant in some areas. When we talk about the Vermont portfolio, we're talking about the Vermont pool, which is that 5% of assets that are contributed to VCF that go into the Vermont pool. And then we have other non-pool investments, and these are mission-related investments that include follow-ons that we've made with some of our DAF partners, like the VCF at Hula. They have some items came over from the High Meadows Fund, the Taproot, which is a food, farm, and forest fund, So we've got a mix here. And as we go forward, we expect to see growth in both pool and non-pool investments. We use a few different vehicles. And so a lot of our work is through intermediaries. We don't do a lot of direct investing. We do have some. So there's about 12% in equity investments that are direct. Venture capital is funds in Vermont. Fresh Tracks we've been in from their first fund. And one of the neat things that we've seen over the last, I would say, 15 years, accelerating quite a bit in the last few years, is a significant increase in the number of funds that are available in Vermont that are supporting Vermont businesses. This wasn't a thing. When I got here in '89, it was very difficult to find alternative sources of capital. And as we've watched over the years, we used to see venture capital come to Vermont, they'd invest in a business, and one of their first expectations would be that that business would leave Vermont and go to Boston. And to have the range of activity that we've got in Vermont means that we're able to grow firms here that we didn't used to be able to retain. And that is creating a substantial amount of job opportunity, wealth, economic mobility. A lot of it is concentrated in Chittenden County. And so we spend a lot of our time thinking about how do we do other work outside of Chittenden County. But it's a really very different landscape than it used to be. And VCF, being an active investor in those funds, has really made a significant difference that they exist at all in Vermont. And then fixed income just means that we're lending somebody money, usually a nonprofit, on a project-related basis. So when we get into a little bit of a look through, our equity investments include some housing and downtown redevelopment partnerships. We've got businesses like Farmers to You that focuses on getting fresh food from Vermont farms to the Boston market. Glavel, which is making a use of recycled glass in a highly efficient, environmentally sensible fill. High Mowing Seeds, and a series of these where we're actually involved with the individual business and then more through the Taproot Fund. What we have learned over time doing these is that they're a lot of work. We have to be a very active investor with these companies. I talk to some of these folks every few weeks. And at times we're talking to them almost daily at important moments of their development. So we're not doing a lot more of this direct work, but we are stewarding a number of investments on this list and others. When we talk about fixed income, this is where we're lending somebody money, often at an interest rate that they couldn't otherwise get for the type of risk that we're willing to undertake. Some of these are very long-standing relationships where they can really count on us as a low-cost source of capital. An organization like the Cooperative Fund of the Northeast isn't just funding co-ops anymore. They're helping an increasingly popular form of conversion for businesses from entrepreneur-owned to worker co-op-owned. And we're seeing a bunch of different transitions as a subset of our entrepreneurship group ages out and they're looking for an exit. We want to be supporting an opportunity for employees to buy those businesses for any activity that results in them staying fixed in Vermont instead of getting bought and moved away. And so we're active through a number of these organizations that are focused that way. And then we have long-term partnerships with VHFA, the Vermont Land Trust, and others that we have. These relationships aren't just, here's our money, give it back to us in 9 years. That's a part of it, but we have very active conversations and then look at individual partners on a case-by-case basis, and we'll co-invest with them in specific projects. We also connect through to our grants and impact team consistently to think about other ways that we might participate. So if I go back, for example, the Northern Forest Fund, we're supporting a small housing development, a repurposing of a downtown building with an intermediate term note. But as an organization, we've also supported other efforts within St. Johnsbury, including some community infrastructure that makes the whole community stronger, not just that one property. So we really try to look at it as an integrated capital perspective and an integrated impact perspective. This is very much a team sport. And then we have these ranges of venture capital funds that really haven't existed until recently on the landscape in Vermont, other than Fresh Tracks, who's been here for a good long time. But we saw a number of fund opportunities last year that were created because the state received some ARPA money that went through to some venture capital investment that VITA was able to make. And we were the matching partner for a number of these funds so that they could draw down that federal match and be able to start up. And several of these are the first fund for the fund manager, which is hard for an institutional investor to get excited about. Most institutional investors really want to see people season on their first fund and then engage, and we're able to really get to know some of these investors, some of these funds, which tend to be very small on a fund one basis, and really get comfortable with their thesis and their skills. And then as they go into fund two, they might become more interesting to a classic allocator who can consider them, bring them into their portfolio with a larger fund and some experience under their belt. And then the Taproot Capital Fund is a joint venture between partnership between the Vermont Community Foundation, now started as High Meadows, and Castagna. And there we actually have a subsidiary that we help operate that has another 8 or so food, farm, and forest investments in it. So we can really get up close and personal with those direct investments without having the same level of exposure to administrative overhead, cost, and burden that we might if we were doing it directly as the foundation ourselves. So that's the spectrum. And then we had recent experience that I thought enough people were interested in when I described it to them internally that I thought I would share it with this group. We had a nonprofit in Vermont that was referred to us by a couple of their board members to consider providing gap funding, bridge funding for a project that they were working on. This is something we very commonly do. We might go in early with money for soft costs for a development project, and we're able to hang in there for a number of years because we don't rely on the Vermont portfolio for liquidity. We ask Mike for all the cash that we're going to use for grant making. We put money into Vermont investments. We do so with a very, very long time horizon. We don't expect to get cash out. So we can go in with a great deal of uncertainty to whether or not we're deploying capital for a 2-year project period or a 10-year project period. The Yellow Barn up in Hardwick I've described before is an example of that. We went in, it took them a long time to work through all of the pre-development stuff, get a new market tax credit closing organized. Now that they're finally in construction, we're getting redeemed during the construction period, but we were in there for a few years longer than we expected. Now, in this case, one of the board members of Outright Vermont knew that we had this kind of activity in our portfolio. Outright Vermont provides youth support and empowerment for LGBTQ plus youth. And one of their programs is Camp Sunrise, or Camp Outright, which is their residential summer camp that has been at capacity for years. They wound up with an opportunity to buy the old Boy Scout camp, which is much larger down in Benson and Orwell. And they were able to approach VHCB for a significant grant for acquisition. This is a project that doesn't just serve outright Vermont and that camp. It ticks a whole bunch of public policy boxes around conserving the land that's involved. It's a 146-acre parcel. There are water quality implications. There's land conservation implications, access to recreational opportunities, as well as the camp itself. And so they thought, well, we've got a big gap between our initial closing date and when VHCB is going to be able to close with us. And could we get some gap financing to cover that 6-month period? By engaging with them and going through the due diligence process and connecting with the people at VHCB, we realized it really wasn't a question of time. There was still going to be a lot of risk, both for us and for the organization, without all of those details getting worked out. But we were able to identify that they had an extension opportunity in their purchase and sale agreement. Really hard to fundraise for a contract clause. That's not one of those things that's really attractive to raise money for. So they didn't see a way that they could do that, but we could look at it and say, oh, this actually would serve the interests of the project a lot better than anything else. So I was able to connect with Holly and team, and we looked at it and said, hey, a small grant that funds the extension is a much better solution than an investment. And so instead of making the investment, we went ahead and made a grant and out of a different pocket and said, let's make sure they've got the runway to really do this project properly. As a result, they've been able to complete substantially more fundraising, get everything set up with VHCB. They're on track for closing, and it's going to be a much, much better solution for the organization, for the project. We missed the opportunity to make an investment, but it's much better if we don't when it's better for the organization. So we really try and look at this from an integrated approach. When we were out at the Michigan Investors Exchange, as Dan said, there's a lot of conversation out there about how to measure impact, how to quantify impact. We do think that's important, but there are many experiences that we have where there isn't going to be a quantifiable impact, particularly when it's a deal that we don't do that makes the biggest difference. So as we go through this year, we're going to be working on new reporting systems and monitoring systems for all of our investments, and that's going to include the Vermont portfolio. So you will begin to see a more consistent format, a more responsive tool set to people's questions. But one of the things we're really wrestling with is what's the degree of quantification for the social impact aspects. And I suspect we will continue to focus more on studies than quantification, because that precision, as we found, doesn't tend to add a lot of accuracy. It tends to be very difficult, is what we heard from partners at MIE. And I will pause there and turn it over to Dan, and then be happy to take questions.
Yeah, let's open it up for questions for Lawrence, Mike, myself. Happy to field anything. Thanks. Thank you both for talking us through each of your portfolios. Any questions from folks on the call?
Quiet group this morning.
Yeah, quiet group this morning. I see Joe Booten coming off mute.
Dan, I have a question because I'm new to the this call process, and my first one, and it'll be brief, from Lawrence. How are you funded? Where does the funding come from?
The funding comes from 5% of all new contributions to VCF, and a DAF or other sources will get portioned to the Vermont pool. And so that's the main source of funding. Is it's an automatic 5% of of money that gets designated for that use.
Thank you. Then Michael, a quick question for you. What's the turnover in fund managers? In the analysis that you showed me over the long term, what is the overall, I can't tell by the presentations going back, looking over the information that you provide.
Yeah, Joe, it's actually very low. We tend to be very patient, do a lot of diligence on the front end. So the turnover is sub 10%. So I'd say, that sounds like about an average of 10-year history, which is not exactly correct because of asset class changes and things of that nature, but it's an extremely low turnover approach.
And the final question is, what's everything shows the return net of fees. What's the average fee cost for in the long-term portfolio for your active managers?
Good question. Hang on. We've been spending a lot of time. So I just want to bring up forgive me for delaying the answer because I want to give you an exact answer. Can we just have that here?
Mike, while
Yes.
you're looking,
Oh, you got it. Okay, go ahead, Dan. Go ahead, Dan. Sorry. Yes.
while you're looking it up, Joe, that's a great question. And we've actually, both of your questions are something that our investment committee and the team at Crucial have dug into in the last meeting and are looking forward, both in terms of if you're holding managers over a long window and you're growing over a long window, which this organization has been fortunate to do in partnership with a lot of philanthropic Vermonters, then you sort of proliferate managers, and that gets to be increasingly complicated over time. So we're looking at the broad range of managers. We're also taking the opportunity to take a hard look at our fee exposure in the long-term pool and the SR pool, just to understand what control we can put into place around that. So that's an ongoing piece of work for the investment committee. Mike, what?
Almost there. Oh, I just found the file. Of course, everything's in 17 places these days. So the long-term pool has a fee rate of 1.04% for the managers. This SR pool, which is more passively managed, is 0.52%. As Dan said, we're looking to drive those down, especially the long-term pool.
That's pretty good overall.
Yeah, and actually the thing that skews the long-term higher is mostly it's got some private equity, which there's been a lot of success in that portfolio, but it's extremely expensive type of investing. And so that's a challenge that we're trying to overcome. Thank you, Joe.
Good question, Joe. Thank you. Other questions? I'm going to start cold calling people. I see somebody in the background and I'm a little jealous of that. I appreciate Lawrence sharing the story about about the Outright Vermont project. I just think from the perspective of the impact of this organization, so much of the value we can generate for partners and for both grantee partners, investment partners, and funders is through the insight we have and the ability to dig into a project and help people come. Sometimes what will be best is a different solution than what somebody may be asking for if you sit down and work through the problem with them. And the value and the efficiency that comes from sharing insight across projects, sharing experience with people pursuing projects, and digging in on those things is one of the things that is one of the ways that Vermont Community Foundation really shows up for organizations making a difference in the state. So the ability to share that insight is a really potent difference-making value. So,
and we rely on our network, including all of you, to learn about projects around Vermont that would benefit from our participation. So don't hesitate to refer people to me when you're working on a project in your community that might fit.
Okay.
Can I ask one more question, Dan?
Sure, Joe.
Again, for Michael. Michael, if you truly believe that the Magnificent Seven are overpriced, is there a way of shorting that position and taking advantage of capitalizing on that in any way?
Well, that's a very interesting question. Yeah, well, so let me start with So yes, you could figure out a way. There are ways to do that. I think there's already a Magnificent 7 ETF. So in theory, you could short that and own the index. I'm not giving investment advice, so I wouldn't suggest that you do that or not do that. But I would say two things. The way we think about how you capitalize on the distortions in the market today. So it's not just that the Magnificent 7 are very optimistically priced. It's that there are so many securities that are so pessimistically priced. And so from our way of thinking, the risk of shorting really popular names with tremendous momentum around them is very high. So that's why I'd be very cautious with the strategy I think you're suggesting. So a better option for us is that if you're here long term, is to just own less of them and more of all these things that are incredibly attractive and have very appealing rates of return. That's what the Vermont Community Foundation for strategies. We're not shorting the Magnificent 7. We're not nothing of the kind, just to be clear. So that's how I would think about it. So there are ways to do it. The other thing, just so you know, that people do, which I'm not advocating for either because it's got its own pluses and minuses, is sometimes when people will buy the equal weight S&P, which you can also do. So then you don't have the weightings in those companies that you have. There are literally 500 companies equal weighted. There's an ETF for that. So there's lots of things you can do. And my key message for everybody is that it's really easy to get sucked into how well this has worked and to look at everything else and think it's inferior. And all I'm suggesting we do is think about history, cycles, and that things do change. Impermanence is part of investing as much as life. And so therefore, you know, I worry about everybody's capital getting more and more concentrated in really popular stuff. And I think that can be dangerous.
Well,
Quietly dangerous.
your managers that you have must be thinking about this, because at some point they're going to get burned by having that concentration in their portfolios that they're managing for you, because they effectively have this risk built into their portfolio. And how are they budgeting themselves from this?
Yeah, well, they're doing what I suggested, which is, by the way, you know, one of the reasons I don't like showing you underperformance, but the underperformance literally comes from them not owning those names in any size. They refuse to own them. And that's where you get to a very interesting questions around the asset management community, which is that at some point, do managers have a responsibility to give people what they want, which is these names, and not worry about the implications of it? Or do they have a responsibility to try to educate their clients and try to say, hey, listen, this is a very big anomaly in history. Historically, it's bad news. So we're not going to do that. And the reason that they don't choose that second door very often is that asset management, if you looked at the business of asset management, it's an annuity business. And what you want to do is you want to keep those fee dollars coming in the door. And so showing your clients that forgive me, I'm being sarcastic, showing that you're a fool and don't own enough Apple and Amazon is a good way to have them leave you. And so you don't do it. And so the incentive systems are really poorly aligned here, Joe. And the last thing is, I think 5 or 10 years from now, if it works out as badly as we think, asset managers will at least be able to say, hey, everybody was doing it, which is not a great answer if you're trying to do something really valuable with your capital.
Mike,
yes.
Sorry, I got to jump in. There's a question in the chat I want to get to. Forrest Newton asked about our governance, so I'm going to take that question for us. We have one investment policy statement for the SR pool and the long-term pool, and a separate IPS for the Vermont portfolio. Given the nature of those transactions and the objectives associated with it, it made sense to parse that out. In terms of the allocations in the SR pool and the long-term pool, with Crucial's advice, our investment committee revisits those asset allocations annually and assesses how to adjust them and whether any adjustments should be made. So that's our governance process. It's an annual look. The committee then makes a recommendation to the board, and the board endorses the asset allocations as recommended.
Thanks, Dan.
That answer your question, Forrest?
I don't know if I'm on or not.
Yep.
You are. We can hear you, Forrest.
Okay, great. Thank you. First of all, I really enjoyed this, Mike, especially. Great information. I like how I'm thrilled that you're using active management for these portfolios. But my question had to do with, my concern or interest was about the benchmarks and the allocations. I mean, it seems to me if you're giving yourself carte blanche ability to change your allocations dramatically each year, then those long-term results don't mean much to me.
We're not, Forrest. These allocations are very stable over time. So that low turnover management point I made also translates to the allocation. Dan's point about it's an annual review by the
Uh-huh.
committee to change the targets is important. And then the related point to that is the committee doesn't even change them every time they look at them. And when they do, it's like watching grass grow, which is very much our strategy, to be very patient and slow moving.
Very much how I do it myself. Thank you very much.
Glad to hear that. You and I are a small group these days.
Watch the grass grow every day.
Exactly.
Joe, I'll go back to you. I know you had, it felt like you had a follow-up. I just wanted to make
Yeah.
sure. I got the floor.
Very quickly, I want to be a devil's advocate here. The one thing about the Magnificent Seven that we have to factor in, particularly on forward earnings, is the bet they're making on AI. It's a whole new field, and NVIDIA is a good example. Is the earnings that they are betting on is the amount of the investment they're making in AI, and what that's going to do to a lot of the businesses that are in the other 493 companies below them. And they're leading that charge. So, you know, I don't want to bet against them because they are making enormous investments, and that's going to really benefit. It's a whole new age for business and how business is going to perform, Michael. So I don't want to bet against them either, but it's got to be factored into this. So that's the last point I want to make, and I'll shut up.
If you don't mind, I respond to that quickly, because I will, because it's an extremely important point. And one of the things that folks like me who say things like I said earlier, you always run the risk of sounding like a complete stick in the mud, living in like the 1880s when those Schiller ratios started, up, no appreciation of what's happening in the world, which I hope isn't true. And let me give you a couple of data points to support what you're saying and what I agree with, and where the opportunities lie. So the first thing is absolutely right. AI is an incredibly powerful technological development. There's literally zero argument about that. The related question, though, would be, or the comment would be, the internet in the late 90s was also a very powerful change in the way the world worked. And how you make money from that as an investor is complicated, let's put it that way. It might be NVIDIA, it might be somebody else. The third thing, and this is the one that really grabs me every time, if you don't mind me bringing this up. The third thing, which is so interesting, is this was about 4 months ago, so it might be slightly out of date. But about 4 months ago, if you took the AI winners, the producers, the picks and shovels companies like NVIDIA, the market had given them a market capitalization of $5 trillion, basically. And it was exactly, Joe, your point that supports that, which is they're going to have such an influence on so many other companies that they're going to be this massive profit machine. All true. However, at the exact same time, the market has ascribed literally zero value to the banks, the healthcare companies, and all the other businesses that are supposedly going to benefit from this. So the question becomes, if it's $5 trillion for the AI companies and zero for the customers, that can't possibly be right. Something's wrong. And so we think the opportunities that the customers are the way to play this going forward, because they're going to have such huge, supposedly profit benefits from this. And the AI companies may or may not make as much as people think. And it's just riskier because everyone thinks they're going to win. So there's a lot to unpeel there, Joe. You and I should have a conversation at another time, a longer term.
Anyway. All right, we're about at time, but happy to entertain one more question if anybody wants to stay on, but I won't take it personally if people start dropping off. Thank you, Joe. Thank you for your questions. Forrest, thanks for asking. Mike, Lawrence, thank you. And everybody, just gratitude for your partnership with the Vermont Community Foundation. The impact we're having across the state and every corner of the state is a pretty remarkable thing to be a part of. And it only happens because funders and fund holders have chosen to entrust us with the assets that allow us to do it over time. Philanthropy is most effective when it works on knotty issues, thorny issues over time, and enduring philanthropy allows us to go to work to do that. And so we are always grateful for the partnership of our fund holders, the nonprofits that hold funds with us, our donor advised fund holders, and folks who are supporting our community impact programs through discretionary funds. Thank you so much.